Welcome to Saxo Bank's morning call on Tuesday, the 27th of March 2019. I'm joined here with Kim Kramer and going to take you through the markets. It will be predominantly an equities update today, but we will go through some FX as well with the RBNZ decision, or not decision, but their pivot last night, but also a little bit on the macro calendar. But if we start with a little bit of an advertisement here for our webinars, we had Ole doing his commodities update yesterday. A replay of that, a recorded version of that, should be available on home.saxo. I will do my equity update today, and then tomorrow we have John featuring his FX update, and they are, as per usual, always at 13:30 CET. And go to webinars.saxo for access. And then a second advertisement, just talked about it before we went into the studio. So the morning call has always been, not always, but it has been available for some time on the Saxo Trader Go platform, but now also it is available in the Pro version, as you can see here. So there is sort of no excuse any longer to not watch the morning call every day. You can access it via the platforms or the homepage, etc. But let's go to markets. We had that RBNZ decision overnight, and there was a big pivot. The RBNZ said it's more likely now to cut interest rate than actually hiking them. So they are now standing or going into the line of all the other central banks being more dovish. If you look here at the chart, Kramer, you can see, we talked about it, you were quite surprised about this. This is, so the two charts, one on the upper left corner, hand corner, is the RBNZ pivots. You can see the overnight interest rate curve has moved dramatically lower from the yellow on Tuesday to the, last night is the black, and the blue line is the current cash rate from the RBNZ. And as you can see here, the market is already now pricing in this more dovish RBNZ, and equities were flying higher. I took a very long monthly chart here just to give you some perspective of what we're looking at here in New Zealand. So we're looking at an equity market excluding reinvestment of dividend that is up 5 times in price return terms since 2003. That's just spectacular. But going to the currency, Ken Kramer, you have some comments there. Yeah. We're sort of breaking out of a falling wedge, but it's typically when we talk about Kiwi, it's against the dollar, but this time around it's a different currency you want to talk about.
Well, actually, yeah, it was Aussie against Kiwi.
Yeah, exactly.
So because I also looked at, of course, at Aussie against dollar and Kiwi against dollar, but here was actually a much more interesting pattern, as we can see here. First of all, it's been falling in this trend channel here for quite some time, then fading a little bit in its sell-off. This screenshot is actually from last night. This morning, it actually broke out of this falling channel, falling wedge, and in a massive move up above 104.25. And if any of our clients are following our trade signals, which we have on Saxo Trader Go, you will actually be able to see all these. You would have been warned, and you could have placed your strategies according to that. But I think there's more in it. But currently, it has paused a little bit, or got rejected a little bit around the 55 simple moving average. But I think there will be more in it in the near future. And also going back to the stock indices, it will push for 10,000. That's going to be interesting.
Yeah, it very much looked like so. Yeah, so a very interesting country and markets, both on the currency and on the equity side. Just want to highlight that John Hardy's FX update will be out very shortly on home.saxo. He's also featuring comments and also trading interest regarding the New Zealand currency, and he's also highlighting Aussie versus Kiwi and actually selling the Kiwi against the Aussie dollar. So there's definitely room there, and he's highlighting the very big move you had in the short end of the yield curve based on this pivot from the RBNZ. Moving to the S&P 500, we had a very ugly Friday. There's concerns and nervousness in the market on Monday, and now it's Wednesday, and we've had 2 days where we have sort of really, 2 sessions where we have sort of pulled higher. Yesterday was, I would say, a pretty decent broad-based, ramp up in the S&P 500. You're highlighting, Kim, this support level 2720 as a key level. Do you see us being in a upward momentum still, or are we just? I know you're saying fading, but how much of a fade?
Yeah, I mean, We are in an uptrend, no question. I mean, we're still having higher highs and higher lows.
Yeah.
But I can also see on the volume and on the strength indicators that I'm looking at that it seems to it's not really supporting the last move here. I think we will see a push to see if they can actually move it a little bit higher, but I think it will be a struggle. So expect a little bit of sideways move here, but yeah, we are in an uptrend. The momentum is up.
Yeah.
But
I think the main two drivers is obviously the US, China, depending on the degree of the trade deal, and then secondly, we're only 2.5 weeks away from the earnings season. If we get a surprise upside, keep in mind there's a lot of downward revisions from sell-side analysts on earnings expectations going into this Q1 earnings season. So if US companies are able to actually surprise to the upside, I would not be surprised to see maybe this index push higher. It looks like the likelihood is, I think the probability is higher that we go back and touch the highs than actually dipping a lot from here. But let's see what happens. Yeah. I did this morning a little bit of coding. We have had a little bit of this talk about the yield inversion, and I went into the history books, and if you look at this chart here, I looked at the 3 months to 10-year inversion, which is the one that went negative on Friday. And if you sort of isolate the independent observations, so if you take the starting date of when you have the first day of inversion, and then you look at how the stock market, the S&P 500 in this case, performs over the subsequent 18 months, then you get this result. So, and then if the yield spread is still negative after those 18 months, then I record a new independent observation of the subsequent 18 months. But it gives you 10 independent observations. As you can see here, the mean return, cumulative return in the S&P 500 on an 18-month basis is minus 11%, and you have some very nasty declines in there. I just took 2 examples. So on the right-hand side, the upper case, it might be a little bit more difficult to see it, but that's the 1998 case where you actually have the yield inversion because of the Asian crisis. We talked a little bit about it on Monday and Tuesday, John Hardy and I. And as you can see here, we rallied 30% into the .com highs. Interesting enough, after this period, then a couple of months later, we had an extension of that yield inversion, and then the subsequent 18 months, it was a massive decline because of the .com. Yeah. And you can see here the 2007, that's a more clear picture here that when you get that inversion, there is some trouble and you have big decline. So I would say this is an important signal. Watch it, but there's obviously a lot of indicators you need to take into account. You cannot use it as a sole indicator, but it has a pretty strong record, I would say. We have to talk about the DAX. This index is quite confusing to me because it seems like it's not going anywhere. It's not responding with the same tenacity than some of the other indices, and we have Chinese equities going high, and Asia definitely is showing some improvement, but there's no spillover effect to Europe. So, I mean, what's your interpretation of what's going on in the DAX?
It's actually quite interesting. Yes, now we have the DAX index with us this morning here, as you can see from this chart. When I prepared for this this morning, I also took a little bit around Europe, and actually DAX and also UK, but especially DAX is the weakest of them all. Even Italy is still going up. Yeah. France is lagging a little bit too, but it was actually quite interesting. But yes, we have this rising wedge-like pattern here we have seen in the DAX being rejected at the 200 moving average. That's a red line coming down there. Now we have a little bit of support around 55 moving average, just below 19,000. I think we could see an uptake here the next couple of days, but the momentum also in DAX has changed a bit here. Interestingly is that DAX is one of the worst performing indices, well, at least the past 6 months or so. Yeah. In Europe. Yeah. So it's going to be interesting the nearest future. Yeah.
And data points continue to be weak on Germany, but as we have highlighted, it seems like there is a little bit of a turning point in South Korea, which could spell that we are closer to a corner in the global economy. But I'll touch on that in my equity update webinar later today. We have to talk about Apple. I highlighted Apple's big event yesterday, and as you said before we went into the studio, there's always this fatigue and negative around some of these events, at least lately. And we have had that again. I mean, it's a pretty ugly chart when you look at the chart you have brought with us, right? I mean, you have had 3 sessions now. Friday was obvious, right? But the 2 last one is around this release of what I would say is the right direction and move for Apple, but the market seems to disagree with my view at least. But what's your take on
as I've written there in the headline, it got rejected. Well, that it didn't even touch 200. So it seems like there's a downward pressure. 184.70 below. If we've got a close below that, then I think we will see a sell-off down to around 170. So it seems like there's more negativity in the stock than usual. I mean, apart from following the rest of the market or being a leader, actually, it's not really that anymore, I think.
It has been a pretty incredible rally, we have to say that.
Oh yes,
from early January and until mid last week, it was incredible. I mean, it's
from around New Year, late December, early January, where everyone was thinking about it's going to collapse totally and the good days are over. Yeah. It's an impressive rebound, I would say, yes. But it seems like it's like S&P 500 fading a little bit in momentum, at least on the short term. So the next couple of days could be quite interesting. Can we bounce from here, or will it break below?
Yeah, I agree on that. We haven't talked about Boeing this week, but obviously it's a big story out there. We have their MAX plane, which has been grounded globally and is still grounded because of this software update we're waiting for this new system called MCAS, and there's also, of course, the litigation risk for Boeing. But it should be a minor issue for Boeing. But we've put a chart on here from a fundamentals perspective before you talk about the technical picture, and we also a little bit talked about it. That we have this duopoly in the world with Boeing and Airbus. You cannot go anywhere else. And as you said, yeah, fine, you can cancel your orders on the MAX plane. The backlog, by the way, is 6,000, and they get 60% of the revenue from that plane. But where do you want to go? You can go to Airbus and you have to wait for 6 years, right?
Exactly.
So you have no options.
You have no option. I mean, you can switch to the 800 plane, which is still in production, but still, I mean, you have no choice. I mean, you can cancel your order for if you have 50 MAX planes in your order book, but you can't go anywhere.
So the fundamentals, I think, is pretty solid. And I just took a screenshot from our equity radar, and it's very, very high quality. It has a score of 1, so it's one of the highest quality companies in the entire stock universe where we have in Saxo of 6,000 stocks. I mean, it's quite incredible. From a technical perspective, it looks like that's pretty much support. I was surprised when I was away for a couple of weeks that the reaction was not bigger, but it is because of this, I think, this duopoly situation.
Yeah, and we are just back to around January, where it really took off there in February. So I still believe that we could see a little bit of downwards pressure, maybe down to around 350, where there's some strong support area around that. I think the big trigger here will, if it actually breaks below 350, well, then there could be another $50. But I don't think it, again, as you said, I mean, it's a solid case. They got barely no debt. They have an order book of more than 6,000 planes. So, and regardless, I mean, they will come out of this. Of course they will. And so, but still, there's a weakness. And it will take a little bit of while to before the dust settles.
All right. Let's go to the calendar to end this morning call. So the macro calendar is pretty light today. We have some consumer and manufacturing confidence surveys out from Italy at 09 GMT, and then at 12:30 GMT you have the US trade balance from January. That's a very delayed one because of the US government shutdown. Then I've highlighted at the 2100 GMT the South Korea business surveys for April. Is probably the first survey on any indication where we're headed in April. I would say this is probably the best as it gets. And I just plotted the South Korea business survey to the right. And as you can see here, South Korea's sentiment has improved dramatically, but it is has been flat, but it's or declined somewhat. But it has stayed a pretty interesting comeback. So watch for that. We won't talk about Brexit. We can talk about Brexit forever, almost, it seems. But so watch the trade balance and the South Korea business surveys, and then we'll be talking a lot more about inflation as we go into the Friday. And with that, we'll say thank you, and we'll be back same time and place tomorrow. Thank you for watching.